Join us now on the markets, Tom Lee. He's head of research at Fundstrat, chief investment officer of Fundstrat Capital, as well as a CNBC contributor. Good to see you, Tom. March came in like a bear, stayed like a bear for, I think it came in about 6,900 on the S&P. We got 6,350 or so, and then a bounce. Last week we're back to 6,580. Your call, I think, like so many of your calls, there's some volatility near term, but then a successful resolution by the end of it. That didn't quite happen in March. I think maybe things are taking longer than you thought for the war, but you're kind of just pushing it back a month, are you not?
Yeah. You know, as March unfolded, the war looked like not to be a short war, but, you know, one that was longer, and I think markets have been adjusting to that. But as you know, we're still in the midst of this fog of war because we don't know when it ends. But we did look at the past 7 major war events, and the stock market adjusts pretty quickly. Within the first 10% of the entire duration of a war, the stock market usually bottoms. So, you know, World War II was almost 5 years, and the market bottomed 5 months into that war. So I do think, as bad as March was, we've probably seen a big part of that adjustment. And now I think the risk reward is quite good for stocks.
And 90 to 95% of the weakness is behind us, in your view.
Yes. And I think people are kind of torn because if someone sold in March and the market, they may have sold 3 or 4% off the highs, and we're just 5% off the highs, they've got a dilemma because the market's only a little bit lower than where they might have sold, but it wouldn't take a lot for the markets to begin to recover. So I do think investors who've gone to cash really have to start to think about how war, as much as it's a crisis, people focus on the negatives initially, but then they need to start thinking about the opportunity on the other side.
We talked about the false start in oil when it sold off. There was also a day where we were down 200 or 300 points. Trump said something, and we were up 1,300 points. So is it spring-loaded right now, but wary? It's like, I think everybody said, well, yeah, we've seen this before. We're going to need more real evidence before it makes a move again like that. But what kind of move would it make if there was a definitive agreement that Iran even admitted to? Because they haven't admitted to anything yet, but that's their playbook.
Yeah, I mean...
You think spring-loaded?
Really spring-loaded, because one, we know that policy and the path of the war is more important than the central bank. So that's the single biggest driver of the stock market. The stock market's getting a bit of a boost from all the defense spending. So the economy is not in horrible shape.
Oil stocks are doing pretty well, too.
Yeah, oil stocks are doing well. But then if there's Middle East peace, of course, that's got a lot of future benefits. So I think if there is a surprise and the war does end, you know, the reaction would be very explosive, as you said.
I just want to read you what, and we're talking what Leslie was talking about earlier. This is the Jamie Dimon letter. Mostly bullish, but then makes this point at the end, sort of one section, where he says the skunk at the party, and it could happen in 2026, which is now, would be inflation slowly going up as opposed to slowly going down. This alone could cause interest rates to rise, asset prices to drop. This would make Kevin Warsh's life a lot more difficult. And interest rates are like gravity to almost all asset prices. And falling asset prices at one point can change sentiment rapidly and cause a flight to cash. Your reaction to that?
Well,
and that's, by the way, his downside scenario. I mean, that's sort of how he's laying it out.
I think that's everyone's concern because we've had several inflation shocks now in the last 6 years, right? The first was the COVID supply chain, and then was the tariff shock, and then this is a war shock that's going through, and nobody wants consumers to suddenly expect higher prices. So I think that's what everybody is watching carefully. But it doesn't mean that just because prices are going up because of this, of gasoline, that inflation expectations are unanchored. So I do think right now it's a critical time for the Fed to have credibility and for consumers not to expect higher prices going forward.
So 7,700 is still your call by the end of the year. Becky and I, we did some great work on Friday. I don't know whether you saw, but
full hour's worth.
We did an average, but we brought a really good jobs number to
Yes.
to the that was a surprise to everyone. The risk on both sides of the dual mandate has been in the forefront of everyone's mind. And you can't even, they're both so bad, you can't even figure out which one is worse. Did that alleviate the weak labor market fears, the recession fears that have been creeping into the market because of the war?
Yes. And I think investors need to keep in mind that wartime spending is, $30 billion and maybe going up to $100 billion a month of economic stimulus. And that does boost the economy. Gasoline, every $10 is about $4 billion to $5 billion a month hit to the consumer. So the monthly spend from the war is much higher than the effect from oil.
Yeah, that is a cynical viewpoint about war.
Yeah.
Forever about war, about how.
Is that why you are not as worried about inflation sticking in there for the longer term?
It's if this is a shorter war and the oil curve doesn't seem to expect it to be into year end, then it's an inflation shock, not a inflation episode.
You don't think the Fed's going to be cutting rates anytime soon if it's not worried about the jobs picture?
No, it wouldn't make sense in the near term. I think market expectations are correct there.
Crypto's fine? You're not, yeah?
Well, after energy stocks, which have done well since the war started, the second best performing asset is Ethereum. And the third best is Bitcoin. They've both been up on an absolute basis and beating the equity market.